Hello and welcome back to Easy Money with Don Anders. Once again, we have Heather Schreiber, a Social Security expert here, and we are going over the two most confusing things with Social Security. Now, Heather, these are the two most confusing. I would say that most people would say that everything is confusing about Social Security, but tell me what you think are the two most confusing things in Social Security. Let's start with the first one.
Yeah, so I would say really what I'd call these is the two most confused concepts. They get sort of interchanged. There's lots to be confused about with respect to Social Security. But these two concepts, the first is the annual earnings test and taxation of benefits. Those two, even by financial professionals, gets confused and muddied a little bit. And so that's why I wanted us to chat about what those two concepts are and how they're similar and how they differ.
Okay, so let's start with the annual earnings. So what do people get confused about that?
So people are surprised to learn that if they claim a benefit prior to their full retirement age, which right now ranges anywhere between 66 and 67, depending upon your year of birth, if they plan to file for benefits and continue to work, there is a rule called the annual earnings test. And simply stated, it says, the Social Security says, hey, we'll pay you your benefit. Yes, it will be reduced because you're taking it early. But if you work and exceed this year, if you're under full retirement age the whole year, if you exceed $18,960 of income, of earned income, then we're going to reduce your benefit or withhold your benefit by $1 for every two over the limit. So using simple math, if I have exactly $10,000 I have earned over that limit, then $5,000 of my benefits are going to be withheld. People that don't know this are surprised because they get an overpayment letter because it catches up with them later. Now, when they file Social Security, one of the questions is, are you working and how much do you intend to make? But if your circumstances change or you don't accurately report that, it can come to bite you later because you'll get this overpayment letter and Social Security will say, we paid you $5,000 too much, please send it back to us. That's alarming. The other thing about the annual earnings test is that if, and using my example, if I have $5,000 of benefits withheld, and if I'm filing for benefits to supplement my earnings, then chances are I need that income, right? But if, let's say my benefit is $1,000 a month and I'm expecting to get my payment the next month, I filed a couple months ago, I'm expecting it next month, but I have $5,000 of extra earnings, they're going to withhold 5 months worth of my benefits before they'll pay me if I have $1,000 benefit, right? So that becomes a serious issue when you're relying on it for income. So really understanding how that works is incredibly important. Questions that I get about it are, what counts as earnings? Well, it's truly earned income. It is not IRA distributions. It's not dividend, rental income, pension income. It's truly earned income. The other question I get is, well, I plan to retire and file early, but my spouse continues to work. Is that a problem? And the answer is no, for purposes of the annual earnings test. It's only your income if you're filing early. Third thing I'll tell you is there is a special rule, usually in the first year of retirement, because let's face it, people don't always retire on January 1st. So let's suppose that I've made $60,000 this year and I plan to retire in June. Well, if I take that, if I'm 62, I say, well, geez, I'm way over the $18,960. I can't retire until next year because I can't get any of my benefits. In the first year of retirement, if you retire mid-year, Social Security will disregard all of those earnings. So in my example, they'll disregard my $60,000, provided from June on, I don't earn more than the monthly equivalent of that $18,960. If I could do my math, maybe that's like 1380 or 14, it's something, 1380 maybe. So that's the first year. Now, fast forward to next year, I'm only subject to the annual test. So the moment I go over that 18,960, no matter what month it's in, I'm going to pay in terms of withholding of benefits. With the annual earnings test, so let's suppose that you were affected by this, and I suspect some people listening are like, yeah, I was affected by that. Once you reach your full retirement age, the annual earnings test does not apply. Also, if you had benefits withheld because of excess earnings, those benefits are restored to you in the form of a higher monthly benefit at full retirement age. So what exactly does that mean? So let's take my example of me. Suppose I'm 62. I worked and I had 5 months of benefits withheld because of my excess income, and then I never had any problems with it again. When I reach full retirement age, my benefit will increase as if I had filed at 62 plus 5 months. So they're giving it back to me in the form of a higher monthly benefit once I hit full retirement age. So it does come back. What I would generally say, the very first thing I ask people that say they plan on filing early, my very first question is, are you working? Because if they are, I'm always going to try. And certainly if it's something that's going to go over that limit and cause a headache, I usually say, hey, is there some other alternative we could use? Is there some other source of funds that we could use to supplement income? Because it just becomes a headache because, you're having to deal with hoping that the calculations are accurate. You're having to deal with the months that you may miss out on benefits because they're withholding benefits. It just doesn't always work that well. So what I would say is be proactive. If it's absolutely something you must do in terms of filing early and claiming a benefit, and you think you're going to be over that limit, overestimate what your income is going to be so Social Security can proactively pull back your benefits. You really don't want to get the overpayment letter because it causes a lot of stress. They do give you some options. I mean, usually it's lump sum, but they will give you some options if you can't pay it all in lump sum. But just, I caution you with getting into that predicament to begin with.
Yeah, and a lot of times what we hear, people don't know about that. So even my father-in-law, he came down to visit, and he's turning 62. And I said, hey, Roman, we need to talk about your Social Security. And he's like, oh, I'm just going to take it at 62. I'm like, you're still working. What do you mean you're going to take it at 62? He's like, well, I paid into it. I want the money. And, he's a construction guy, he's not a finance guy. And I said, Roman, you're not going to get anything if you take it. All you're going to get is a penalty for the rest of your life.
Right.
And so, that's huge. And what you said about one of the biggest misconceptions that we see is what you said about the first year exception. So a lot of times we'll have people that come in and they say, well, I'm going to retire December 31st because I've already earned too much. I want to take Social Security. No,
right.
we can take it now. It doesn't matter how much you've earned as long as you're not going to earn it moving forward. So that's really good. Okay, let's get into taxation. This is a pretty big question that people have. A lot of people come in and they say, well, Social Security, my Social Security is not taxable. I've already paid taxes on it. Or they'll say, I have to pay taxes on all my Social Security. And there's a lot of confusion. So can we get into that?
Yes, absolutely. So the worst case scenario is that as much as 85% of your Social Security benefits can be subject to tax. There's always going to be 15% that will never be taxable. So that's dispelling that myth that some people think all of it's taxable. But it doesn't take a whole lot of other sources of income for your benefits to be subject to at least some exposure to taxes. So the difference, so these two are the concepts. The annual earnings test and taxation of benefits are often confused. And I'll tell you what the differences are. Taxation of benefits is potentially an issue that can go on forever. It's a gift that can keep on giving. It doesn't disappear at full retirement age. It also doesn't just take into account earnings. There's something called a provisional income calculation, sometimes called combined income. If you look at Social Security website, they call it combined income, same thing. And it's a function of three things: your adjusted gross income plus 1/2 of the Social Security benefits received in the household. So if you're married, you're going to combine all the collective Social Security benefits between you and your spouse, divide by 2. That becomes part of this calculation. And then tax-free interest, things like municipal bond interest that is federally tax-free, but for this purpose gets pulled back in. So if you're a muni bond lover, this can become a problem when it comes to Social Security because all that tax-free interest now gets included in provisional income. So what is, people say, okay, so what goes into, what kinds of income is calculated in? Well, anything that goes into your AGI. It could be your traditional IRA distribution, a 401k distribution. If you're lucky enough to be one of the fortunate few these days that gets a pension, that obviously we know is fully taxable. Most people that have pensions are going to pay social taxes on a portion of their Social Security benefit. It just is the facts. Rental income, you name it, capital gains income, all of the things that go into AGI, earnings. That's another reason that I'd say, hey, even if you could on the annual earnings side avoid an annual earnings penalty, but your spouse is working, making lots of money, does it make sense for you to still file? Because A, you're going to get a permanently reduced benefit and you're going to pay taxes on it. So might it be better to wait until you're both retired? That's just food for thought.
And the gap there between paying nothing to paying 85%, paying on 85%, it's only about $10,000.
Yeah, and here's the depressing part is that it was the 80s that taxation of benefits became a thing. And it has never changed. The thresholds have never changed. So if you're single and your provisional income is under $25,000, it's under $32,000 if you're married, then you don't pay taxes on any of your benefits. So these are the folks that are largely living on Social Security for their income. They don't really have other sources of income. If you're single and your benefit or your provisional income is somewhere between 25,000 and 34,000, as much as 50% of your benefits taxable. Now, hear me clearly that it's up to. It isn't a cliff vest. It isn't that at $25,001 you're going to pay taxes on 50%. It's a calculation. There's a worksheet in IRS Publication 915 that you would go through to determine how much of your benefit is subject to tax. If you're married, those thresholds are 32,000 to 44,000. So if your combined income is anywhere between there, as much as 50%. Once you exceed the 32,000 or the $34,000 mark if you're single, or the $44,000 mark if you're married, as purposes of combined income, then you're looking at as much as 85% being taxable. That doesn't mean it's taxed at 85%, and I hear that too. It just means that, you know, if you've got $10,000 of benefits, 8,500 of that could be exposed to taxation. So, you know, that is something, again, people think, well, you know, once I hit full retirement age, it doesn't apply anymore. No, because they're confusing that with the annual earnings test, which doesn't apply. But taxes are always a potential issue. So how do you combat that? Well, you pre-plan ideally. You want to plan and say what kinds of income isn't included in that provisional or combined income calculation. I mean, you and I know, Don, right? What kinds of income can we think of?
You know, you have Roth, you have
Roth, right? Qualifying distributions from Roth IRAs. Are tax-free. They don't hit that provisional income calculation. If you take tax-free income from a life insurance policy, a cash value life insurance, there's very few things that really don't hit that calculation. But if you do some forward planning, perhaps you can set yourself up better to have less erosion of taxes on your Social Security benefit. But it's certainly something that everyone needs to be mindful of when they're planning for retirement.
So I know some financial advisors where their entire planning process is to get people most of their money into either the life insurance that they could take distributions from or Roth accounts, because if they do it that way, not only is it not taxable for those distributions, but it's also not, their Social Security will be tax-free forever as well. And so you're looking at a truly tax-free plan. And if you think about retirement planning, and I've done videos on this. I'll link the one that I did, which is my biggest concern in retirement planning for my clients. But if you think about it, the scariest thing is taxes, because you can control what the market's going to do by using safe investments or CDs or something like that. You can control medical costs with insurance and Medicare and things like that. But the one thing you can't control is taxes. And the one thing that we have no idea what's going to happen in the future is taxes. So if you're making $100,000 a year now and you're paying 20%, then you're making 80,000. But what if taxes go up to 40 or 50%? Now, not only are you not getting cost of living adjustments, you're actually going backwards significantly in your benefits. So I completely agree with you. There are those strategies that you should take a look at to try to get your Social Security to zero. But people also need to realize that, you know, depending on what they do, sometimes a distribution from your IRA might throw you into that, you know, making 85% of your Social Security taxable, right?
Exactly. And you know what happens at 72 now, right? We're forced into it with RMDs. And so, you know, this is where, you know, pre-planning and thinking about, you know, claiming age, you know, needs to take into a whole host of considerations, like what other sources of income am I going to supplement my retirement with? Does it make more sense perhaps to, you know, front fill my income need in retirement with those taxable dollars? I mean, right now where taxes are on sale through the end of 2025, unless something changes. Does it make sense to do that and hold out for a larger Social Security benefit later and less of an RMD because we've front filled our income need? So you really need to think about all of those variables, because taxes, I mean, really, it's a scary thing to think about, you know, what could happen, you know, what could happen with taxes, and, you know, getting that guaranteed income and not having to worry so much, stay up at night thinking, oh my gosh, if the taxes go through the roof, am I prepared for that?
Absolutely. So, all right. So two biggest mistakes, just to recap, are taxes and
so I would say two most confused concepts. most confusing concepts because they get interchanged. So it's the annual earnings test and taxation of benefits.
Perfect. Well, thank you so much for doing this with me, and we'll see you in the next video.
Thank you.
Thank you so much for watching my video. I hope you enjoyed my interview with Heather. If you click here, that is the full playlist with all of the videos that I did with Heather about Social Security. And then if you click here, you can go ahead and subscribe for more content just like this. We focus on retirement planning. We focus on making investments easy. And we're going to be having a whole series all about interviews with experts. So please subscribe and we'll get updates and alerts on that. Also, Heather has a newsletter that if you'd like to subscribe to learn more about Social Security, you can do that. We're going to link that down in the description below. Thank you so much. Have a great day.